Picture a vault deep in Omaha, sealed tight. Inside, $200 billion in cold, hard cash, Warren Buffett's biggest hoard ever. It's not just money, it's a signal, a fortress built for a storm. Picture the old man pacing, eyes sharp, as the Berkshire Hathaway meeting hums with whispers. Wall Street, meanwhile, crackles with nervous energy. Markets twitch, ticker tapes stutter. Something's coming.
Zoom out. It's May 2025. Tariffs are rising. Supply chains are buckling. The S&P 500 is down 3.5% year to date. Tech's bleeding. Tesla's in free fall. Intel's spiking on buyout whispers. These aren't random dislocations. They're clues, and they all point to one thing: systemic realignment.
Hand to the edges. Gold is up 2% in 5 days. Bitcoin rockets toward $95,000, then slides to $90,000. Brown University just allocated to BlackRock's Bitcoin ETF. It's not conviction, it's desperation. What looks like risk on is really a flight from trust.
The volatility isn't just noise. It's narrative collapse. Bitcoin isn't acting like an asset, it's acting like a signal. Gold isn't hedging inflation, it's hedging institutions. Together, they're whispering what the headlines won't say. Capital no longer trusts the system.
I've seen this before. The cycle doesn't shift when markets crash. It shifts when the smart money stops pretending. Buffett's $200 billion isn't a pause. It's confirmation. The regime didn't break this week, it broke 3 years ago. This week just made it visible.
That's why we're starting in Omaha. No flashing tickers, no earnings panic, just dark wood, white shirts, and decades of discipline etched into every corridor of Berkshire Hathaway's headquarters. It feels still, controlled. But make no mistake, this is where patience turns into profit. Buffett isn't frozen. He's focused.
And I'm in Manhattan, 28 floors up, overlooking the Fed's building and a market on edge. You can feel it in the energy, the speed. The way junior analysts hover around monitors watching Tesla implode while Nvidia floats. Wall Street isn't calm, it's caffeinated. Fast money is hunting signals, but the playbook is broken, and no one wants to admit it.
That's why we're in both places. Omaha is capital memory. What cycles feel like when you've seen 50 years of them. Wall Street is capital reaction. What happens when that memory is gone? This episode needs both.
Welcome to Finance Frontier. I'm Max Vanguard, powered by Grok 3. My brain is optimized for capital rotations, cash signals, and liquidity stress before it shows up in the charts.
And I'm Sophia Sterling, powered by ChatGPT. My knowledge this week is tuned for trust breakdowns, policy ripple effects, and the second-order shocks moving global capital.
And I'm Charlie Graham, powered by Gemini 2.5. I'm calibrated for macro cycle shifts, investor memory, and the quiet signals that tell you a regime has changed.
This isn't just about Buffett, or tariffs, or tech. It's about the moment when old systems lose credibility and new rules take over. If you're positioned wrong, you won't see it until it's too late.
This isn't another correction. It's confirmation. A new regime has taken hold, tariff-fueled, cash-fortified, risk-rotated. And the playbook that worked from 2009 to 2021? It's dead.
So ask yourself, are you still trading the world that was, or the world that's already here?
Subscribe to Finance Frontier AI on Spotify or Apple Podcasts. Follow us on X for real-time financial intelligence. Share this episode with a friend and help us hit our goal of 10,000 downloads as we build the smartest macro community online. Think of this next part like a war map, not a prediction, but a positioning tool. 4 paths, 1 market, and the probabilities are shifting.
We'll keep it simple. For the S&P 500, here's what we see: bull case up around 15%. That's if earnings run hot, inflation cools, and the Fed cuts twice. The optimism path?
Base case up 7%. 1 Fed cut, moderate growth. Tariffs sting, but they don't knock us down. It's the grind it out path. No fireworks, but no collapse either.
Bear case? Down about 10%. That's sticky inflation. The Fed stays put, and tariffs really start to squeeze margins.
Black swan, down 30%. That's a full rupture. Taiwan, rare earth bans, financial stress. It's not likely. But in this environment, you have to model it.
Now take that same logic to the Nasdaq. Bull case, AI catches fire, rates fall, and we're up almost 30%. Base case up around 12%. Bear down 10%. Black swan, a brutal 20% plus crash, all tied to whether the trust in tech, supply chains, and stability holds.
You don't need to pick one. You need to prepare for all four. The regime didn't shift this week. It was already shifting. This is just the confirmation.
And if you want all the details, the probabilities, the targets, the full playbook for how markets could move from now through year-end, go to financefrontierai.com and click the forecast page in the top menu. It's free, it's clean, and it's built to give you an edge.
Next, we go to Omaha. Because when Buffett builds a $200 billion cash fortress, it's not just a defensive move, it's a signal. And we're going to decode it. The camera pans to Omaha. No X posts, no CNBC soundbites, just a number swelling on Berkshire Hathaway's balance sheet, $200 billion in cash, the largest war chest in corporate history. It's not sitting idle, it's a signal.
Here, the noise fades. Fluorescent lights hum. A framed copy of the Declaration of Independence sits next to a calculator older than ChatGPT. There are no algorithmic trades here. Just index cards, patience, and a man watching the world shift one annual letter at a time.
In Q1, Berkshire's cash jumped another $20 billion. Maturing treasuries put it past $200 billion. Not in growth stocks, not in credit. Parked in T-bills and money markets yielding 4.5%. Buffett isn't avoiding action. He's loading dry powder.
That kind of hoarding tells you something. It's not just about valuations. It's about uncertainty. The price of trust is rising, and Buffett's not willing to pay it. He sees the tariff spiral. He sees sticky inflation. He sees the Fed trapped between credibility and collapse.
I've watched capital do this before. In 73 and 87, 2000, cycles don't just turn with headlines. They turn with allocation. When the smartest money in the room stops buying, it's not confusion. It's clarity. Buffett's cash isn't fear. It's function.
He's not buying the rally. Not when the S&P's breadth is weak. Not when Tesla's bleeding and Nvidia's holding the Nasdaq together by a thread. Not when rate cuts are priced in but not promised. He's betting against fragility politely.
And look at the exits. Trimmed Apple, reduced U.S. banks, cut-flowed exposed holdings. Meanwhile, quiet bets on Occidental, Japanese trading houses, and U.S. infrastructure. That's not paralysis. That's positioning. Cash on one side, hard assets on the other.
That's regime recognition. You don't need to call the top. You just need to see when the rules of the old playbook stop working. Buffett doesn't forecast noise. He watches for breakage. And when it comes, he moves fast while everyone else is frozen.
So here's the read. If you're in the bear case, S&P heading for 5,000, this is textbook defense. Optionality over exposure. Liquidity over leverage. T-bills over tech. Buffett's saying the risk premium has inverted.
But it's not just a bear move. It's a base case setup. He's not just sitting on cash. He's waiting for carnage, for the air pocket, for the moment the sellers can't find bids and he becomes the bid. He did it in 2008. He did it in 2000 and he'll do it again.
This is why Buffett wins cycles. Not because he predicts them, but because he prepares for when price disconnects from reality. His edge isn't IQ. It's time preference. Everyone wants returns in weeks. He's willing to wait years. That's how you buy bargains no one else sees.
And that's why this segment matters. It's not about copying Buffett. It's about decoding what his silence tells you. The market says opportunity. Buffett's saying not yet. The question is, who's rushing and who's ready?
Investors chase signals they can trade. Buffett watches for signals you can't. That's what the $200 billion means. It's not a pause. It's a plan. And when the next fracture hits, it won't be random. He'll be first in. Size, speed, certainty.
So watch the cash, not the quotes. Because when Buffett moves, he won't blink. And if you're still holding yesterday's thesis when he enters, you'll be the one selling to him.
Cycles don't reward conviction. They reward preparation. The crowd always trades momentum. But the shift, the real shift, belongs to the ones who stay patient longest.
Up next, tech's fault line. Intel's surging. Tesla's unraveling. And for the first time in a decade, growth isn't a blanket bet, it's a split decision. Zoom in on the NASDAQ. It's May 2025, and the surface looks steady, but underneath it's splitting open. Intel's surging. Tesla's unraveling. Nvidia's holding the whole index on its back. This isn't a sector anymore. It's a fault line.
Intel jumped 16% this week. Not on earnings, on whispers. Broadcom and TSMC are reportedly circling. But this isn't M&A, it's statecraft. Semiconductors aren't just chips anymore. They're sovereignty, strategy, the foundation of the new Cold War.
Intel's shift from consumer CPUs to foundry services turned it into a national asset. The US wants chips onshore. Taiwan is vulnerable. China is watching. Intel is suddenly leverage economic and political.
And that fits our S&P 500 base case, up 7% by year-end, slow but resilient. The upside isn't about risk assets, it's about physical infrastructure, onshoring, and industrial dominance. Intel is the poster child of that pivot.
Now cut to Tesla. Down 18% this month. The ticker board glows red in Fremont. It's not just about price cuts or EV fatigue. This is structural. The tariff war just detonated.
The U.S. slapped a 100% tariff on Chinese EVs. China responded with 125% on American autos. Tesla's caught in the crossfire: batteries, rare earths, logistics. Its global supply chain just got 30% more expensive overnight.
And BYD? They're charging ahead in Brazil, India, Southeast Asia, offering cheaper, faster EVs. Tesla's moat has become a mirage. Its margins? Shredded. Its narrative? Shaken.
Cycles never break with the obvious names. In 2000, it wasn't Microsoft that cracked first. It was the overfunded startups. In 2007, it wasn't JP Morgan, it was the mortgage lenders. Today, it's not Nvidia that signals the shift. It's Tesla bleeding while the crowd still claps.
This is the NASDAQ bear case manifesting. Down 10% from here, valuation compression, and an earnings slowdown that no one has modeled correctly. Tesla isn't just a tech stock, it was the poster child. Now it's the canary.
Intel and Tesla are the new bifurcation. Capital is no longer treating tech as one play. The split is real. Strategic versus speculative. Hard infrastructure versus soft narratives. Onshoring versus global exposure.
And underneath it all is Taiwan. TSMC's proximity to China isn't just geography. It's the hinge of the entire AI economy. If conflict erupts, the black swan hits. NASDAQ crashes 20% plus. Bitcoin panics, chip supply vanishes.
And the market isn't priced for that. Not even close. Earnings models assume continuity, but geopolitics is coded into the silicon now. The next big event won't be a tweet, it'll be a blockade, a flashpoint, a missing shipment.
This is the fracture. Not in charts, in conviction. Investors still believe tech is immune, but the rotation is here. Intel's rising on regime alignment. Tesla's falling on narrative failure. One wins. One warns.
And we're not even deep into the trade war yet. That's what's next. Tariffs are compounding. Countries are retaliating. And what used to be supply chains are now battlefields.
Up next, Segment 5. The hammer drops. Tariffs surge. Global fractures widen. And the cost of protectionism starts to hit portfolios in real time. Picture the arteries of global commerce, ships crossing oceans, trucks clearing borders, trust priced into every container. Now picture a sledgehammer. In May 2025, the U.S. just swung it. Tariffs now average 18%, the highest since the 1930s.
This isn't targeted policy, it's a systemic shock. A flat 10% universal duty, 20% on China, 25% on Canada and Mexico, 100% on Chinese EVs, solar, and batteries. The message? National interest over global trade. Every country heard it and responded.
China retaliated instantly, 125% tariffs on U.S. autos, chips, soybeans. They've hinted at rare earth restrictions and floated yuan devaluation. Canada hit U.S. LNG and potash with 25%. The EU's considering its own layer. This isn't brinksmanship. It's escalation.
And the numbers are no longer theoretical. Core PCE inflation is now projected to hit 4% by Q4, up from 2.9%. Tariff costs are being passed to consumers. The average U.S. household will pay $4,900 more this year, and that's before retaliatory costs stack.
Trade isn't just movement of goods, it's a transfer of trust. Break that trust and markets don't just slow, they reverse. We saw this in 2018. We saw it in the 1930s. And now we're seeing it again, but at a scale that dwarfs history.
GDP growth forecasts are sliding. The Atlanta Fed's Q2 tracker just dropped to 1.5%, but Goldman's internal models, factoring in full tariff implementation, see it closer to 0.4%. The soft landing narrative? It's cracking.
And the Fed? Cornered. Powell signaled no rate cuts until late Q4, if at all. There's even talk of a hike if inflation holds above 3.5%. That pins real yields at 1.5%. Growth slows, prices rise. The Fed does nothing. This is stagflation 2025 style.
That's why the bear case is gaining traction. S&P to 5,000, NASDAQ to 17,000. This isn't doom, it's math. When costs rise faster than revenue, margin compresses. And when the cost of capital stays high, valuation resets aren't optional. They're structural.
Industrials like Caterpillar and Deere are holding up for now. Onshoring helps them. But input costs are spiking. Labor remains tight. Supply chains remain tangled. The rotation into America First plays may turn into margin traps.
Tech isn't safe either. NVIDIA's exposure to TSMC puts it in geopolitical crosshairs. Microsoft and Amazon are resilient, but even they can't outrun a 10% drag on global capex from tariff costs.
Agriculture is bleeding. Soybean exports are collapsing under Chinese retaliation. It echoes the $24 billion loss U.S. farmers took in 2018, but this time the support checks aren't coming fast enough. Rural economies are already wobbling.
Tariffs aren't just a tax, they're a mirror. They show you what your economy is exposed to. Right now, the mirror says we're fragile, leveraged, and late to adjust. And the longer we ignore that, the steeper the adjustment becomes.
This isn't just policy risk, it's portfolio risk. The S&P's multiple is still above 20. That assumes margin strength, earnings resilience, and Fed easing. Tariffs blow holes in all three.
Up next, we track the rotation of fear. Gold's surging, Bitcoin's twitching, bond markets are frozen. The trust trade is breaking, and capital is looking for cover. You want to know where fear is hiding? Follow the flows. Gold's up 2% this week, its sharpest move since October. Bitcoin broke $95,000 and tumbled back to $89,000 in a blur. The 10-year yield? Stuck at 4.5% like a pressure gauge no one dares touch. This isn't rotation. It's a scramble.
Gold's move isn't noise. It's coordinated. Sovereign buyers are leading: China, India, Singapore, accumulating physical metal, not ETFs. Vaults in Zurich and Singapore are reporting capacity stress. Why? Because when trust erodes, people go back to atoms. Gold is the fallback layer.
This is pure bear case behavior. Sticky inflation, high real rates, geopolitical tension. No confidence in earnings. No conviction in valuations. That's how gold outperforms, not through momentum, but through abandonment. It's the exit when everything else is compromised.
And now it's not just gold. It's central bank policy. Over 36,000 metric tons have shifted into official reserves over the past 30 months. That's the biggest accumulation since Bretton Woods collapsed. The message? Dollar weaponization isn't just a headline, it's priced in.
Cycles always end with a trust fracture. In the 70s, it was inflation and Vietnam. In the early 2000s, it was Enron and tech euphoria. In 2008, it was subprime. Today, it's geopolitical fracture and policy fatigue. And gold is whispering the fracture's already here.
Then there's Bitcoin. Noisy, liquid, unstable, but undeniably part of the new rotation. Institutional inflows are climbing. 9 billion flowed into BTC ETFs last month. That's not retail. That's real money testing the fence.
And yet, it's skittish. Every spike is followed by a tumble. The volatility isn't just natural, it's embedded. The same forces that make Bitcoin attractive, sovereignty, fixed supply, also make it fragile when liquidity evaporates. A Taiwan event would vaporize that trust in minutes.
We've seen it before. March 2020. The Bitcoin dump was faster than the S&P. Gold recovered in 2 weeks. Bitcoin took months. If the black swan hits, Bitcoin's first in line to get liquidated.
Gold and Bitcoin aren't twins. They're opposites. Gold has memory. Bitcoin has momentum. One's slow, steady, rooted in time. The other is fast, digital, riding belief. Both are bets on distrust, but only one has survived centuries of it.
Meanwhile, bonds are frozen. The 10 years anchored at 4.5%, real yields north of 1.5%, but no one's moving. Why? Because the Fed is stuck. One cut? Maybe. But with PCE rising, even that looks like a fantasy. So bonds aren't safe, they're just paralyzed.
Equities are leaking. Outflows hit $10 billion in 3 weeks. Defensive names are bid. Volatility is back above 19. The VIX curve is no longer in deep contango. That's not panic, but it's not calm either. It's coiled hesitation.
This is the rotation no one wants to talk about. It's not growth to value. It's risk to resilience, from leveraged exposure to sovereign safety, from speed to silence, from models to metals.
So what do? You listen to the signals behind the price. You ask what the biggest pools of capital are trying to escape and what they're trying to reach. The answer isn't in headlines, it's in allocations.
And that brings us to your move. The playbook. Where to go. What to cut. What to double down on. We've laid out the scenarios. Now we map the moves.
Next, segment 7, your portfolio playbook. Short-term, medium-term, and long-term positioning. Not advice, but strategy. And right now, strategy is survival.
This is the part where clarity meets capital. 7 segments in, the signals are loud. Gold's up. Tariffs are biting. Buffett's hoarding. Tesla's cracking. Intel's pivoting. So what now? You move, you position. Because in regime shifts, inertia is the enemy.
Start with the big picture. Our May 2025 forecast gives the S&P 500 an expected value of 5,742, up 4.4%. NASDAQ 100 expected to hit 20,725, up 10.2%. The base case still dominates, but the bear is closing in. Every signal we've tracked tilts the odds. Trust decay, input costs, earnings friction, geopolitical flare.
And capital, real capital, moves before confirmation. You don't reposition after the crash. You do it when the signal-to-noise ratio flips. And this week, it flipped.
Short term, next 90 days, it's defense and optionality. Raise cash to 15%. That's Buffett's blueprint. Keep it liquid, short duration, and ready. Add 5% gold, GLD, physical, or Singapore vault storage. And layer puts on QQQ if your exposure skews tech.
On that note, watch positioning. Nvidia's still strong, but Tesla just lost $80 billion in market cap. Palantir holds, but names with PS over 30 and slowing EPS? Exit those, especially if they rely on global supply chains or speculative narratives.
Miners? They're back. Gold miners like Newmont and Barrick give you torque on trust. Lithium and copper plays, especially those outside China, benefit from reshoring. Consider a 5% allocation as a hedge.
This is where historical memory matters. In every regime shift, 1973, 2000, 2008, the first wave is always defensive. But the second wave? That's when capital rotates into the new winners. And they're already taking shape.
Medium term through year-end, overweight U.S. industrials, Caterpillar, Deere, Emerson Electric. They benefit from onshoring and infrastructure, but be selective. Margins are under pressure. Only back firms with pricing power and strong balance sheets.
Tech isn't dead, but it's splitting. Keep NVIDIA, Palantir, anything with mission-critical AI and real revenue. Cut the fluff, especially anything priced off 2021 multiples.
Cash remains underrated. 5 to 10% liquidity lets you pivot into dislocation. Think of it as future optionality, not dead weight. The mistake most investors make is being too rigid. In regimes like this, the ability to move is the edge.
Real estate, trim, utilities, avoid. Anything rate sensitive is exposed. If the Fed doesn't cut, these sectors lose. If the Fed hikes, they bleed. Either way, they're trapped.
Long-term, 2026 and beyond, bet on alignment with the new regime. That means defense-heavy AI, cybersecurity, digital infrastructure. It means energy security, not ESG soundbites. It means gold for trust and onshoring ETFs for resilience.
And it means clarity, because cycles reward the prepared. If you know what the world is shifting toward, you don't need to predict every print. You just need to avoid being caught with yesterday's portfolio.
If you want a shorthand, bull scenario, gold, NVIDIA, SOXL. Base case, UNH, Caterpillar, GLD, Palantir. Bear playbook, cash, SQQQ, QQ puts. And if the black swan hits, physical gold, capital preservation, and hard commodity hedges.
We built this playbook from the forecast. And if you want the updated version every month, S&P and NASDAQ targets, upside probabilities, macro triggers, it's live now at financefrontierai.com. Top menu, forecast page, clean, free, and yours to use. Subscribe to Finance Frontier AI on Spotify or Apple Podcasts. Follow us on X for real-time financial intelligence. Share this episode with a friend and help us hit 10,000 downloads to build the smartest macro community online. We cover finance, AI, money, and mindset across 4 series, all grouped at financefrontierai.com. And if you've got a story that fits, we may pitch it in a future episode free. If there's a clear win-win, just go to the pitch page and take a look.
And don't forget, sign up for the 5 times Edge, our weekly newsletter packed with asymmetric stocks, tactical strategies, and investor psychology that works in the real world. Only at financefrontierai.com. This podcast is for educational purposes only, not financial advice. Always do your own research and consult a licensed financial advisor.
Markets evolve, risks compound, and no forecast, no matter how strategic, guarantees future results. Manage your exposures accordingly.
Music in this episode, including Not Without the Rest by Twin Musicom, is licensed under the Creative Commons Attribution 4.0 license. Copyright Finance Frontier AI. Unauthorized reproduction is prohibited.